Before I start this video on how to use a cash savings ladder to boost the interest you earn on your savings, please make sure you hit that like button if you find anything in this video useful, and also subscribe to our channel. Now, everything I talk about in this video is on the Money to Masses website. We put a link to the article in the notes below this video, and that's because there are numbers and things that I'm not going to talk about in the video because it makes terrible viewing, but you can see the detail to prove the concept that I'm talking about by looking at that article in conjunction with watching this video. Now, what is a cash savings ladder? So you might hear the term savings ladder, cash ladder, and I will use them interchangeably throughout this video, but I'm referring to a concept to help you boost your interest rate. Now, what would typically happen if you had a sum of money that you wanted to put into savings? You would try and pick the best bank account offering the best interest rate. Now, typically what that would mean is you would gravitate towards something called a fixed savings bond. Now, you may hear them called savings bond or fixed term savings accounts. They're all the same thing. So I will again use those interchangeably throughout this video. But a fixed term savings bond is an account that will give you an interest rate if you lock your money away with the bank or building society for an agreed period of time. That's typically 1 year, 2 year, 3 year, 4 year, or 5 year. The advantage of doing that is that you will get a better rate of interest on your money because you lock it away for that extended period of time. The disadvantage is you lose access to that money. So you either can't access it, or if you are able to, there will be some kind of penalty, typically something like you lose the interest or there'll be a fee. Now, the current rate of interest you might get on an easy access savings account as I make this video, the best in the market is about 2.75% per annum. That's 2.75% interest. Now, any interest rates you hear me talk about in this video are obviously annual rate of interest. Now, if you compare that easy access rate to, say, a 1 year savings bond, you can get about 4.5% a year if you lock your money away for 1 year. If you lock your money away for 5 years, you can get over 5% at the moment. Now, rates have obviously really jumped up in recent months. If you lock your money away for 2, 3, 4 years, then you will get somewhere between 4.5% a year and 5% a year interest. Now, the problem is, let's say you had £100,000. You were lucky enough. I'm going to use a big number because it makes it easy to do the maths. Now, you could put that in a 5-year bond. Now, you've got no access to your money for 5 years. That's quite a period of time. You might get the 5% interest a year, which is obviously really good and positive, but you don't know that you might want to access your money. Now, I'm going to assume you've got your cash savings emergency fund in case your boiler breaks up. That's somewhere else in an easy access account. I'm talking about money now that you want to try and get a return on. Now, you might not want to lock that £100,000 away for 5 years to get 5%. What you could do instead is use the concept of a savings ladder. Now, what you could do, you could decide to split your money into 5 equal pots. You don't have to do it equally. It's up to you how you do it. But for this example, I'm going to go for 5 equal pots with £20,000 in each. What I'm going to do next is put £20,000 in a 5-year savings bond. Then I'm going to put £20,000 in a 4-year savings bond, £20,000 in a 3-year savings bond. You can see where this is going. £20,000 in a 2-year, and then £20,000 in a 1-year savings bond. Now, that means that in a year's time, the 1-year savings bond is going to mature with the interest on top, and I can then put that into a new savings product. All of the other bonds will go one step up the ladder. So you can see I'm creating a visual ladder here. They'll go one rung and they're 1 year closer to maturity. At the end of year 2, obviously the 2-year savings bond will now kick out the money plus all the interest that you've earned on that. What you do at the end of each year is you could technically take the money you get from each maturing bond and put it in a new 5-year savings bond. So hopefully you might get a better rate. So you can see you keep doing that. So at any given moment, you've got your money locked in savings bonds, but each year about 20% of your money is going to mature, and then you can put it into another 5-year savings bond. The advantage of this is that if you imagine a year ago when savings rates were about 1%, that's the best you were going to get. If you put £100,000 in a 5-year bond, you would be pretty upset right now because you're getting hardly anything on your £100,000, yet saving rates have leapt up because interest rates in the economy are rising. By using a savings ladder, you could have taken advantage, as your money matured each year, you could have taken advantage of better and better savings rates, especially on those 5-year fixed rate savings bonds. Now, there are drawbacks, because obviously that means that at any moment to get all your money back, you've got to keep waiting 5 years for each of the things to mature, and then you'd finally get your money back. That's because you keep putting money as it matures back into a 5-year savings bond. Now, if you do that, you could argue that maybe you should consider investing, because your money is being locked away at times for 5 years and beyond if you keep doing this, in which case the conventional wisdom is, if you're happy to lock your money away for an extended period of time beyond 5 years, then investing might be for you. I'd counter that with people who are risk averse, who don't want to lose capital, because don't forget, you can lose money if your investments fall. Assuming your bank doesn't go bust and you're covered by the Financial Services Compensation Scheme, then you will get your money back in a savings account. So you might like that certainty. So that is a disadvantage. The other disadvantage is, of course, savings rates could drop over time. So you could find yourself looking back with hindsight and finding that as each bond matures and you buy the next 5-year savings bond, that you're getting worse and worse rates, and then you would have been better off just locking all your money away at the start for 5 years. Well, that's hindsight. What we're getting here is flexibility and improving the interest rate. Now, going back to the examples that I said earlier in terms of interest rate, what this means, if you average it all out, by the end of, say, the first 5 years, you would have got an interest rate that wouldn't be 5%. It would be somewhere in the middle between the 1 year and 5 year bond rate. So it'd probably be something like about 4.8 something at the moment, using the examples I used earlier. That is obviously positive because you've got more flexibility but a better rate. An alternative option is, instead of moving the money when it matures into a new 5-year fixed rate savings bond, you instead put it into an easy access account. So you could just get the money. Then each year, around about 20% of your money will keep dropping into this easy access account. And so more and more your money you can access more freely over this 5-year period. And by the end of the 5-year period, all of your money as it's matured will end up in an easy access savings account. Now, if you recall, I said you get about 2.75% at the moment on an easy access savings account. You can find the best rates by clicking on the links in the show notes. We cover all the best rates on savings accounts, whatever the type of account, on the Money to Masses website. Now, if you'd done that process that I mentioned, overall, when you do the maths and you allow for compounding, everything like that, you probably would have got around about 4% interest on your savings. But you've increasingly had more of your money in easy access accounts. So that is a positive. So the more flexibility you have, the lower the rate. But rather than leave your money in easy access for the whole 5 years where you'd have got just 2.75%, you can restrict that access yourself using this principle of a savings ladder, and then you actually boost your rate of return. Now, as I mentioned, there is an article that goes into full details about how this concept works, with figures, with numbers and pros and cons, which you can look at, and we've linked to in the notes of this video. So if you found this video interesting in any way or useful, make sure you check out that article, but also please do click the like button on this video and subscribe to our channel.